Well, thanks for tuning into IPO Adda and an upcoming issue, Equitas Small Finance Bank. And it'll be interesting to get the management perspective in a space which is largely believed to be probably able to do much better than what the established non-small finance banks could do. Mr. PN Vasudevan Johnson right now to talk about his sense of how the business environment looks like and what should you as an investor expect out of this. Mr. Vasudevan, good having you. Thanks so much for joining in. Hope all is safe.
Yeah, thank you so much and thanks for having us.
No, the pleasure is ours, Mr. Vasudevan. Niraj here. Good morning. Just wondering, can you tell us a bit about this? I mean, what is, I mean, just for the uninitiated people, what is the reason for this issue and what will the proceeds, if any, be used for?
So we started the banking operations 4 years back. And as per RBI guidelines, we are supposed to list the bank within 3 years of starting operations. We completed the 3 year actually last September, but we couldn't list it by then because we were trying to do a scheme of arrangement, but that did not go through finally. And we were about to do the IPO in March, but because of the lockdown, that could not be done. So we are now back at it and we are hoping to complete the IPO now and comply with the regulatory requirement. We are raising 280 crores of primary issue in the issue, and the holding company is selling 7.2 crore shares as part of secondary in the transaction. The 280 crores of primary that we raise will go into the bank's network, and that will help us in terms of our growth capital. The capital adequacy ratio of the bank is about 21, slightly over 21% now. And post IPO it goes slightly over 22%. So that is good enough to support the growth of the bank for a period of time, maybe 2 years, maybe 3 years. We also don't have much of tier 2. In fact, we have practically no tier 2 at all. We have very, very small tier 2. So somewhere down the line, that's also an option to the bank to raise tier 2 to support growth besides the tier 1 capital. As far as the holding company's shareholding in the bank is concerned, post the IPO, the holding company should have something in the range of 82 to 83% stake in the bank. So that's the basic construct of the IPO.
And I presume, I mean, you kind of partly answered that, but a hygiene question with this capital raising, as you said, you won't need to raise any further capital in the SFB for the next 2-3 years.
Yeah, I mean, normal growth. You see, in the last 3 years, we have been growing around 30 to 35%. So, I mean, so this kind of a capital that we have is sufficient for supporting that level of growth over the next 2 to 3 years.
Okay. A lot of people believe that for the SFB business at large, the focus is firmly on new product growth, efficiencies, getting extracted in the business as well. How would you reckon the SFB is placed considering the kind of growth trajectory that you've already shown and the environment that we are in, Mr. Vasudevan?
Yeah, actually, see, the SFBs are in a kind of a sweet spot because, you know, all the SFBs, all of us are NBFC turned SFB. Yes. So our genes is NBFC, and NBFC in India really means the ability to go and lend to very small borrowers, the inclusion kind of a customer, financial inclusion kind of customers. So that's the basic DNA or a tenet of NBFCs. So we are all NBFCs. So which means that as an organization, we are tuned. Our DNA is tuned to handle very, very small ticket loans to small borrowers. But as a bank, you certainly have the benefit of accessing deposits at a better rate than what typically NBFCs could raise money. So it's kind of a sweet spot between a bank which has the access to deposit and an NBFC which has a DNA of lending to the informal economy, small borrowers. So it's kind of an amalgam of these two. And if you see the NSSO survey of 2013 by the central government, the report lays down that there are over 60 million small businesses in India with a total credit demand something in the range of 12 lakh crores, of which only 4% is serviced by the banking sector. This is a NSSO survey of 2013. So you see a large amount of that unmet, that demand from the small business community is unmet by the banking sector. And most of the SFBs and definitely Equitas, we have a very strong role to play in that sector. If you see our asset spread, we have microfinance, which is about 24% of the book, We have commercial vehicle finance, which is principally or predominantly a used commercial vehicle, where a driver turning into a owner. We have 25% of that book. Then we have small business loans, which is for all these very, very tiny entrepreneurs, like running a kirana store or running a restaurant, eatery, running a two-wheeler mechanic shop, this kind of businesses. We have 40% of our book in that, and that is secured by the house property of the entrepreneur. And then we have 5% in SME and 5% in NBFC lending. So if you look at our entire advances book, 90% of our loans are to the informal economy customers. And if I remove microfinance, then my average ticket size is only 4 lakh rupees. So that's the kind of loans that we give. And that's the kind of spot that we have been specializing. And we have been doing this business now for between 8 and 13 years, depending on the product. Our products are our collection efficiency in August was around 83-84%. So the typically this kind of borrowers, when the cash flow comes back, when they start to opening their shop, the speed to recovery generally is very fast, because these people really deal in daily use product and services. So the speed to recovery generally is very fast, and that's why we have seen a consistent increase in our or improvement in our collection efficiency over the last few months as the lockdowns kept opening up. Now, in terms of COVID and its possible impact on the credit cost of the bank, we have created two separate general provisions for COVID. One we did in the month of March 2020, and then one more we did in June 2020. So put together, we have created a buffer of around 145 crores between these two periods for a general provision on COVID. And this 145 crore in our case translates to something around 0.9 to 0.95% of our advances. And of course, besides this general provision, our specific normal provisions is something that's parallelly going on simultaneously. So, but this is something extra on top of that that we have created. So we are kind of ready for any possible COVID impact, and so we have to see how it pans out. But I think we are fairly geared for that.
Okay. Last couple of questions, Mr. Vasudevan. One is whether you expect that. I'm presuming that, like everybody else, your bank is adopting technology and using technology to acquire customers at a faster pace. Plus, you might be increasing your distribution as well in these times, since the organized ones can do that. Would you reckon the pace of the customer addition would be faster, more nimble, and more cost efficient?
Yeah, actually, just before the lockdown, we had launched our selfie savings account product, which is a product where customers can open an account online and start transacting. Yeah, selfie. So it's a selfie. We have named it a selfie savings account. And when the lockdown happened and our staff couldn't go out physically and meet clients, then our staff started engaging digitally with the clients. And surprise of surprise, pre-COVID, we used to open something in the range of around 10,000 savings accounts a month, based on based on the effort of about 1,300 feet on street or field staff working on the field. But once the COVID lockdowns were announced in the first quarter, that is April, May, June, we actually opened 55,000 accounts. When no one could actually move out, none of our staff could really move out. We opened 55,000 accounts against a possible 30,000 quarterly run rate that we are having pre-COVID. So it's actually more or less doubled. And we have seen the traction, digital traction and traction very high. We have seen the adoption by the customer also very good. And subsequently, of course, RBI has introduced a video KYC. So we are also one of the very early banks to launch the video KYC. So we now feel that going forward, definitely digital will be one major channel for us in terms of sourcing our customers and also engaging with them, for transactions. Another very interesting thing that's happened is that somewhere between August, June, July, August, our number of transactions in the bank has more or less come back to the pre-COVID levels. It was very low in April, May, and picked up, and it's more or less back to the pre-COVID level. Now, pre-COVID, we had 94% of our transactions which are done, in a non-branch channel, either an ATM or internet banking or a mobile banking channel. In the post-COVID period, we see 97% are actually doing non-branch. So it's actually gone further up from 94. It's actually moved even further up to 97%. I think that adoption of technology is definitely very strong, and we believe that I'm just like I'm sure all banks are working on this, and maybe over time we will find that the entire digital footprints are substantially increasing, in the country.
Sure. One last question, Mr. Vasudevan. What should somebody who's either through the normal route or maybe post-listing buying into the secondary market expect in terms of growth from his investment in the stock of this thing? I'm not asking for a stock price recommendation. I'm asking what kind of growth could the underlying business show?
As you know very well, we are not permitted to give a guidance for the future. On any aspect, we are not allowed to give a guidance. So whenever people ask me for anything related to future, I only take them back to the past and leave them at that. So if you see our last 3 years, for example, if you take, we have been having a consistent advances growth of something in the range of around 35%. And if you see my NPA over the last 3 years, it's consistently remained in the range of 2.6, 2.7, 2.8. So we have shown the ability to grow around the 35% level, and we have also shown the ability to manage and contain our asset quality at a very comfortable level. And if you look at my credit cost also, it's our average normal annual credit cost is in the range of around 1%. So we have kind of established the performance metrics of the bank in some of these parameters over the last few years. And our cost income, if you see, it was about 82%. Now it's come down to around 65, 66%. It's come down over the last 2 years. And there's a lot of leveraging opportunities still left. We have 850 odd banking outlets. So there's still a long way to go in terms of growing the bank with the current network of branch banking outlets that we have. So this is the kind of scenario on which we are sitting. Now, how much we will grow is not something that we are permitted to talk about, but I'll leave it at that.
Fair call. Wish you all the best for this and the outlook ahead, Mr. Vasudevan. Lovely talking to you. It's been a while, but good having you.
Thank you. Thank you so much.
And viewers, thanks for tuning into this leg of IPO Adda.